Alright, so this is a 5 minute chart of the SPY, basic Wyckoff analysis. What I'm going to do using, wave chart analysis, which is very old. Alright, so we'll just start off with um, the left hand side right here. Alright, so you had, you know what? Alright, let me just start off from here and then show the trend change. So over here you had 20 minutes and 17, it's really 170 ticks, which is $1.70, right? So I should have put $1.70, but I don't want to go through changing all the stuff. Anyway, so it's 20 minutes, then 5 minutes, then 10 minutes, then 10 minutes, and watching the down waves is what I want to do. So the first pullback is obviously just 5 minutes and 15 minutes, 10 and 10. Do you think that the market's going to reverse? No. Why? Because the down waves are not increasing in distance and duration and volume. So it's not gonna change, because any downtrend will have bigger waves on the downside than an upside. An uptrend, the waves will be bigger than the down waves. That's the only way it's gonna go up, right? So it's just Wyckoff knew all this, and he just created a wave chart. So over here you have the down waves: 15, 10, 10, 5, 10, 10, bang, right there. This is the first time you see the what? The distance and duration, meaning the selling power and the lasting power increase. That's the first time. Does that mean it's gonna just change? No, it doesn't. But you have to check the pullbacks to determine what's going to happen. So over here again, you want to look at the down waves in uptrend as well as the up waves, but the focus really needs to be on the down waves in my opinion, because that's the only way you can identify the change. So here, 5 minutes. Here, 15 minutes, 11 ticks. So you might say, oh yeah, 5 and 15, increasing in distance and duration, but sometimes you have to apply judgment and say, wait a second, the market didn't break a low, look at the move up, it's 12 ticks versus 11 ticks down. So you can see that although this pullback here has more distance and duration, it actually has less distance than the rally. So keep that in mind. Over here you have 10 minutes and 7. I'll just start labeling this. So 5 minutes and 6 ticks, same. 15 minutes and 11 ticks. Supply did increase, there's no question, but supply is still weaker than demand power, because demand power is 12 ticks up and supply is 11 ticks down. Over here you have supply is weaker. Why? Because it's 10 minutes and 7 ticks, so obviously it's weaker. What's weaker? 10 minutes is less than 15 minutes, so lasting power is weaker, and 7 ticks is less than 11 ticks, which means selling power is also weaker. Here you have 10 minutes and 6 ticks. Obviously, it's the same amount of time and less amount of price. It's going to continue to go up. Right. Now, as this happens, I'm always trying to take a look at the breakouts as well, because that's how the market moves. When it goes up, it breaks out. It just breaks out until it has problems breaking out, and then the thrust shorten and the volume decrease, and then you get some type of change. In this case, where is the breakout? The breakout is right over here. right there, where the volume increases by 48%, and so does the range. So, and that bar before it, I see this a lot, meaning breakouts, they typically, the good ones, they're preceded by dullness in terms of both range and volume, meaning the volume before the breakout it's very little, and the range is also not that great, meaning it's average to small. And this is just an example. See, this volume on this red bar is actually only 61% of the prior bar. So the volume shrank, and that gives the bulls a reason. It gives the bulls a reason to get aggressive and break out, and that's what they did. So then it goes up, ding, 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 go 5 minute, 10 minute, 10 ticks. Again, these are just 10 minutes, so don't just take it as a hard and fast rule and try to code it in an indicator. It won't work. You have to use judgment. I've tried it. Believe me, you gotta just have it up here in your head and be able to make the calls. Why? Because the market's fluctuations of up and down, they're infinite, and they'll fool every indicator. But for some reason, your mind can pick up these, I don't want to say the word patterns, but it can pick up these behaviors and put them together, piecemeal them by comparing them to prior behavior. And indicators are unable to do that. Why? Because it's like you can never say there's a perfect breakout bar. It's always a bar that's certain amount up with a certain amount of volume, which is less or more than the prior breakout. So it keeps changing. Anyway, bottom line, this is the breakout. It goes up here, rallies. Now we watch the pullbacks. It says, shit, it's only 5 minutes, 5 ticks. 10 minutes, 10 ticks. 10 minutes, 6 ticks. What is noticeable about here? The selling pressure weakens. Why? 10 minutes, 10 minutes, and actually 60 cents. I put 6 ticks, but it's really 60 cents. So just add a zero and change the T to a cent. Anyway, so it goes up, 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 down, and then finally it breaks out again. Now what's noticeable about this breakout is the volume is quite high. This breakout has the biggest volume in, I think, 23 bars. So you look at this and say, that looks bullish, right? It looks bullish because it's coming from less volume and all that, looks like a bull flag, and bang. But like with most breakouts, you have to wait for the test, and you have to look for follow through. Well, two things you want to look for: follow through and wait for its test to see how it responds. Because especially if the market, in this case, believe it or not, this breakout bar is actually a climax. So I don't want to get into all of the the climax looks like a wave and all that shit. It doesn't need to. It can look like a bar. In this case, you have a high volume bar with the biggest range and thrust. So this bar is actually the climax. So now the question comes, how do you distinguish a breakout versus a climax? That it really depends on the situation. Like over here, it looks like a breakout bar, right? So it's a little bit confusing. Does that mean that you can't tell if it's a climax? Well, if it's the biggest bar in the entire trend, it's suspect. Because a breakout is a breakout, but if it's exceptionally large and there are multiple waves up and it has no follow through, there's a problem. So, because who's going to buy up high? It's not the CM. So, relatively speaking, you have 1, 2, 3, 4, all of these waves, and then bang, they're going to buy this bar here. But they buy low and sell high, not buy high and have no follow through. This is again very difficult to detect, and only judgment can interpret that behavior, because based on its mechanics, you can easily say it's a breakout, but based on judgment, you question it, at least question it, or wait for a pullback or something. Like right here, the volume spike, biggest volume, 23 bars. What else do you see? Oh yeah, the range is exceptionally large. It's actually the biggest range in the trend. Problem. Something that doesn't seem right. Okay. After that, when you have climax over here, it gives the CM an opportunity to unload. So that's why the volume increases. And by how much? 200%. So the volume increases 200%, and then selling comes in. So that selling after the increase in volume is the biggest wave in the trend. I think it's the biggest wave in the downtrend. So it's like 27, which is bigger than 10, 17, 15, 12, 12. There is a 27 here, but it's definitely bigger than the one before it, 15. So it's coming from the climax, and you'll see this together, which is the climax followed by a change of behavior. Why is that the case? Why does it happen again and again and again? It's tradable. The reason is because the CM wants to sell at the best prices. The way he does that is sell on the way up until he's satisfied or he can't sell anymore, and then he sells on the way down. So you're getting the best prices as the market goes up, and then when it can't go up anymore, or there's a sense of urgency to take the market down, then sell on the wave down. So that's why when the CM steps in, you see selling on the way up and down. And this is just one case. Or you go check trends and you see this shit over and over again. And I mean like on every time frame. Seeing it obviously on the daily. I'm showing it now on the 5-minute, but this is the case. Here, bang, sell. Now, this is very important when it tries to pull back. Okay, before I go there, here is the first time you have a wave that's 25 minutes and 8 ticks. That means it has increased in distance and duration. So, what does that mean? Distance is ticks and duration is time, which is what? It is selling power increasing and lasting power increasing. You need both. Alright? Especially for a change. So here you have supply increasing very clearly. And it's preceded by a climax, which is also interesting because it's only 5 minutes, but it goes up 13 ticks. Why is that? In this case, it's like a quick, I don't want to call it an upthrust, but in the old explanation of upthrust, it's just like it's a quick thrust up, and that's it. It's not like, okay, there's a range, you have a resistance point, and you go slight penetration above and then below, and it could be on low volume or high volume, or it's upthrust 1 type, a 2 type, a 3, A, B, C. No, that is that's like another definition somewhere else. This idea of an upthrust is that it's a quick upthrust to new highs, relatively speaking, to the trend, and then goes right back down. And over here, you see it goes up and gets sold off while selling is increasing. Now, what you want to see is the pullback. Pullback is on 10 minutes and 4 ticks. What is interesting about this? Well, from the time perspective, it's same or more, so it doesn't show weakness, meaning 10 minutes, right? It's more than 5, and so it seems like it's lasting. But if you look closely at the distance, you'll see it's 4 ticks or 40 cents, or actually 40 ticks. But anyway, the reason is I divided it by 10. Anyway, so 4 ticks. Now watch, the 4 ticks is an indication of buying power, right? That 4 So 4 is less than 13, it's less than 9, it's less than 6, it's less than 21, it's less than 8, it's less than 12, it's less than 12, it's less than 17. And that's the start, the change of behavior here. So from the whole trend, this wave is the smallest wave. Bingo. What does that mean? It means that buying power is gone. It's gone. So this is your lack of demand, your feathers weight, your, what else have I heard called? I forgot. I forgot. So that right there, the indication is not, is this indication came from the perspective of price. Alright, and it is a total outlier, meaning out of all those waves, it's the smallest. So it's not normal. It's an indication of buying weakness. And then it breaks. So that's it. The chances for this trend to go down on this time frame is quite high. I've explained to you clearly why. You have a climax, or fake breakout, or quick upthrust, whatever you want to call it. It is a move up on heavy volume, big range that cannot be sustained, and is followed by immediate selling. So there's your immediate selling. 27 down. Sell on the way up into the breakout, sell on the way down, and buying attempts, it's weak, sell some more. This range expands, which is very good. And then after that, you have this 15-minute and 9 ticks that just test this area, right? And here the volume is 106, volume's 92, right there's the breakdown, right there. So some may say, what do you call this? I mean, you just call it a breakout, but Wyckoff, when he called certain things, he made the statement about certain bars. He said, this is the bar that breaks the back of the trend. In that case, this is that bar that breaks the back of the trend. So when it takes out this level right here, now what do you know about this bar? You know that the volume has increased. That bar range and volume is the biggest in the last 16 bars. Volume has increased on that bar by 78%. So what do you think is going to happen? It's done. This uptrend on that 5-minute chart is finito. So anyway, I'm just going to label this. So the climax is here. The change of behavior is here. The feathers weight, or whatever you want to call it, lack of demand, is here. It goes down, goes up. I can't really see anything other than a retest. And finally, the bar that breaks the trend is right there. That's the first breakdown. Alright, the breakout to the downside. How do you know it's legit? Look at the volume, look at the range, and look at the background. Meaning, breakdowns or breakouts, whenever they occur and to change trend, they have a certain background. That background should be telling you a couple of things. It should be telling you that positions are established. That's the first thing. That's evidence right here, where it says 27. The position's established. That's evidence right here on this bar. That's the biggest bar in 23 bars in terms of volume. Positions established. It should also be telling you there's exhaustion. Demand is exhausted, and this is the evidence by this weakness of only 4 ticks. Demand is weak, and after that it breaks. So we piecemeal all of this information together, and then you get the idea. Anyway, make a long story short, goes down, down, and like it does all the fucking time, it tests that same area, you know, and breaks some more. And again, this time broke on the biggest bar in 30 bars. Biggest volume 30 bars. So just draw that, and you see that's right there. And how you know that it's good is expansion in range, expansion in volume by 211%. It's legit. And also I like the fact that it pulled back. It pulled back, tested, or did its thing, and then it broke. So it's not running away. It's like over here where sell, come up, and then break it. All right, now come up. It's pulling back. This is very important for it to do that, because you want that pullback that that is like cock and load it and then break it. Pull back, cock and load it, and then break it. It's like giving them, believe it or not, it allows a couple of things that are happening when it pulls back. These are not just consolidations. All right, these consolidations, they're not just consolidations. A lot of times, this random look-like behavior is actually redistribution or reaccumulation. That's what these consolidations are. That's when positions, it looks random and like, oh yeah, it looked like an ABC or whatever terms they give, or just an upthrust, but it's actually a lot of other things. There's testing going on. There's a lot of stuff going on. Like over here, it goes up for only 5 minutes. So what does that mean when it goes up for only 5 minutes? It means demand is exhausted and then breaks. Right over here, I'm sure something like the power of demand is gone to a certain level. Sometimes they do stop runs, etc. But the point is, there's some behavior that's pulling back and then breaking, which I like a lot. And in this case, it goes down, pulls back up, over here, comes up, and then breaks. So anyway, so this is what's the left hand side of the trend is right there. So you have your climax, you have your change behavior, you have your weakness in trend, and then you have your breakout. And now what you're looking for is a test of that breakout. This is very nice. It basically rallies down, test, retest, sell. Here you had a market that's going down and demand increased right here, right? And pulled back and broke out on this bar, which increased in volume only 9%. So I'm not too crazy about this bar. And I like the action after it though. It tests right here and then slowly hinges. Like what's going on in this box right here? I don't have a square, but this right here, when it goes up and it makes higher lows and it's holding, it's telling you it's going to break. Because it's making higher lows and it's coming to almost like an apex, this is because it's absorbing the sell orders in that area. Am I crazy about these trades? Not really. Because it's difficult for me to know where to put the stop and all that. So, but that's what's going on. This absorption, then the break. Why? This is the resistance, so they go back to the resistance. Selling attempts, it's not enough selling. That's why you have higher low, and comes back. It's not ready to break out just yet. Why? Because they're absorbing, and comes back down, and again it's a small range. Why is it in small range? Because it's not enough selling that's able to take price down. Why? Because there are buyers there. As the red bars try to go down, they're bought. Eventually there's nowhere to go, and the area is cleaned up and it breaks. So one more I'll just do right over here. Yeah, this one I can't really see it clearly. 43, 33, 15, bang. Now this turn I can't really detect it, so no point. Let's see, where else? I think here. This one. So you have 15 minutes, 7 ticks, 5 minutes, 11 ticks, 10 minutes, 11 ticks, 5 minutes, 8 ticks, 15 to 5. 5 and 10 minutes, 5 and 10 minutes, 5. It's the first time you have 20 minutes and 15 ticks, $1.50. That's the first time. And what do you notice? The buying waves are getting bigger and the selling waves are getting shorter. It's critical information. Buying waves are getting bigger, selling waves are getting shorter. So I'm watching this, where it goes down only 5 minutes. And then it reverses. So this is the first time demand is greater than ding, 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 all of them. Right? And it's 20 minutes and 15 ticks. 15 ticks bigger than 8, 8, 11, 11, 7, all the way up here. So it's bigger than 1, 2, 3, 4, 5. And now you have a down wave, but that down wave is 20 minutes and 16 ticks. This is some shit that always happens too. Like, there's different variants, but after a change of behavior, you can have pullbacks that are weak, or you can have like attempts to drive down to see if they work or not. This here is an attempt to drive down and create some type of spring. It does that, rallies here, and then eventually over here is where you get effort. So this is effort right here. We could also call it dullness. Wyckoff called this dullness. Why? It's 1, 2, 3, 4, 5. These small, weak bars, and together, because there's so many bars, that's why the volume is high. But really, it's all these bars. They're dull. All right. Eventually goes up, down, 10 minutes, and ready to break out. How do I know this breakout's happening? This bar is the biggest volume in 21 bars. Takes out this area. Right there. So it does that, goes down, pulls back, and here, I mean, you can't really, you can't really, you can't expect the market to always go up, 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 up. Sometimes all it does, like over here, is form a counter trend back up, and the purpose of that counter trend is just a test. Like, all it's doing is it's filling in the gap. All of this, and what is it testing? It's testing this bar right here, the breakdown. So that's why you have to be very careful when counter trending, because this breakdown here, all this did was test that breakdown. So when you're watching this behavior, like, at least expect that when it goes to a form of breakout or breakdown, there's going to be an attempt by sellers to come back in. And if the buyers are not strong, this is what's going to happen. Here you have a different story, because I consider this like, let's just I don't want to call it like a breakdown because it's like overnight action, but it eventually takes out this area right here with this breakout, which is the biggest volume, 33 bars. And I know it's going to go up because that's what it's going to do. Um, why? Because it's taking out an area, it's breaking out, and it's pulling back on low volume, which is like a supply. Goes up, tests, goes up, eventually absorbs and breaks out. So anyway, the way to go about doing this, from what I know, um, is because it's based on judgment, right? You don't want to go sitting down at the market and looking at it and trying to like identify every wave and see, is it this, is it that. This is not what you want to do. This is like something you won't really learn from any course, but the idea of watching a market and trying to label every wave as it occurs, this doesn't work because over time your judgment will fail and will be overcome by greed and basically what you want the wave to be. You want it to be a change of behavior or a climax or an opportunity to get in, and that bias will seep in into your cognitive process when you're looking at a chart. So that's why you don't want to just look at a chart and try to quote unquote figure things out because the bias or wanting to make something be what it isn't is very high. And this may not occur in the first hour, may not occur in the second hour, but before the end of the day, if you're a day trader, it's going to seep in because you're trying to make money in the day. So that's what happens. So one way to avoid this is to have like in your head a sequence and just look for that sequence. That particular sequence. Now, what's the difference between looking at waves and trying to classify them? Is different than knowing what to look for and just waiting for it to appear. They're two different things. So you want to already know what to look for um, and be ready for it. Just when it presents itself, that's when you look for it. Now, this means that you're only looking for like maybe one or two things. If you have too much knowledge and information, it will mess with your ability to execute. Because let's say if you have like 5 or 6 patterns, holy shit, none of them are gonna work because your mind is focused on one, then it gets to the other, then the third, then the fourth, then the fifth, be all over the place. It's like a guy looking at 10 stocks or 20 stocks during the day. His mind is flipping back and forth. It won't work. And already 5 different setups on all those markets. It's not going to work. What you want to do is already know what you're looking for and just wait for it to present itself. When it does, sharpshoot. Anyway, done with the lecture. Take care. Bye.